as investors digest the latest developments across earnings, trade policy, and of course, the ongoing government shutdown. Joining me now is Jay Woods. He's the Chief Market Strategist at Freedom Capital Markets. Jay, welcome to the show.
Good to be back. How are you?
Well, thank you. So as we're heading into this session today, what are you following most closely?
Oh my God, there's a lot to follow. We follow social media to see what tweets are coming out between the president and China negotiations. But I think the thing we have to focus on are earnings. Earnings story has been kind of overlooked by the shutdown, by the tariff negotiations with China. But earnings have been really on point. You mentioned Taiwan Semi kicking off the show. Bank of New York had solid earnings on the heels of the Big Six that reported earlier this week. So to me, this is strong earnings growth is what's going to lead us and what we'll end up focusing on once we get through these other hurdles in the shutdown and obviously China negotiations.
What are your expectations for the remainder of earnings season?
Yeah, I mean, the expectations have to be considered high now. We've had a lower bar, yes, and the financials are clearing them. They're clearing them well. And the stocks that are reporting right now, I consider backbone stocks, like the backbone of industries. You have the financials. We have a transport in J.B. Hunt reporting earnings that blew out street numbers. Transports have been lagging. That stock's up 12% in the pre-market. If that can continue to stay above 150, maybe the transports have changed. And when you're looking at bull markets historically, you want to see the industrials and the transports both making new highs. The industrials are right there. Transports have lagged. If they can turn, this is really optimistic for me going forward for the next 6 to 18 months.
And let's talk government shutdown.
Yeah.
We are on day 16. How do you think the markets are pricing in political risk for that?
So far, we're kind of, just digesting it, but we're not going higher. The news that we're getting, the market should be going higher, and it's just not. We have this cloud of uncertainty, and the longer the shutdown goes, and we talked about this last week, the longer the shutdown goes on, the more it could impact the GDP, and that isn't good for the economy. So if we go into another week, and God forbid, go into November, then the market could probably say, you know what? I'm going to speak for you right now, have a sell-off, and that will get the attention of Washington. But as the market continues to just go sideways, trail under the 20-day moving average, it's not really going to impact or get people rushing to get to a deal because the market's telling them we can handle it.
And what do you think is holding it back?
What's holding back? But the deal back? It's just political posturing. And if there was a little more noise from the market, from reaction to it, then we'd see them get to the table. But these things will get done. It's just a question of when and how both sides can claim victory when they get to the table and hammer out this deal.
And as we head toward the next Fed meeting, do you think the data still matters, or do you think the narrative is already set for that?
Yeah, well, happy CPI day. This was supposed to be a day we were talking about inflationary numbers, and that will come out on October 24th, a week from Friday. So the numbers matter. The data matters, especially for a Jerome Powell-led Fed where he was very data dependent. He had comments earlier in the week that point us in the direction, yeah, we're going to get a 25 basis point cut, regardless if we get the data before that next meeting. So that's what's holding this market up. But we would like to confirm that, joblessness is at least stabilizing, that the first cut is stemming the tide, and then maybe a second cut's needed. And then on the inflation side, we're not getting data that's saying we're going back toward their 2% goal. So hopefully we can get through this logjam, get some more information that will let our leaders at the Fed make, more informed decisions. But right now it looks like the Fed is on pace to cut at least one more time at the next meeting and probably a second time in December.
All right, and what is your outlook for the economy given the rate cut expectations?
Yeah, I think earnings growth is going to continue. I like the small caps now. They have confirmed that breakout of 2,400 in the Russell 2000, now trading above 2,500. Small caps are just catching up. We're seeing rotation into some of the laggards in the transports, and then the backbone stocks, those financials. We're seeing M&A activity in the regionals, and the regionals start reporting today, the rest of the week and next week. And the big banks, they're humming on all cylinders. So to me, this is what you want to see in a good growth, broadening base rally, and then tech continues to lead. Taiwan Semi's numbers today, phenomenal. So we'll talk about tech in the next few weeks when we get into the Apples, the Microsofts, the Nvidias of the world. So right now, it's hard to find something that's going to cause a stumble in this rally, but China will be the main stumbling block. We saw it back in 2018 when Trump and Xi were going through negotiations. This time, there's more of this, taco feel, like Trump will back down. This is how we negotiate. We're getting used to it. So as long as we don't get that unexpected story, and you never get hit by the bus you see coming. So we're expecting this, we're expecting that. Something will come that could derail it. I just don't know what it's going to be right now, because tariffs are not, shutdown is not, and earnings growth continues. So it's hard not to be optimistic as we go into the year end.
And you mentioned small caps. The Russell 2000 recently hit a record. What are your thoughts on small caps in general? We're hearing more and more about them.
Yeah, small caps, I never really like small caps, I'll be honest with you. But from a trading point of view, you have a good risk reward setup. And as a trader, former trader down here, that's how I look at everything. When I talk to this audience, any audience, is the risk more favorable or less favorable than the reward? And the reward looks like the upside has a long way to go. Long way in small caps, 15 to 20% over a 12-month period, given the breakout that we've seen. And if we fall back, we go below this 2440 level in the Russell, then I rethink it. But right now, when you have a Fed that's going to cut rates, you have a broadening growth in the economy, I think small caps are a good place to be. I wouldn't go all in on small caps, but you want to have some of your portfolio allocated to the small caps at this time, because I think they're going to, lead us in the fourth quarter and then continue to be a good performer over 2026. I forgot what year it was.
Any other growth opportunities you see in the market right now?
Any growth opportunities right now? I'm watching the transports carefully. That J.B. Hunt earnings report, these stocks have a lot to reverse. So you look at the Knight Swifts of the world, the Schneider Trucking, and Old Dominion. These stocks have been beaten down. Maybe we're going to see them come back. Watch this FedEx and UPS. If we get through this tariff talk with China, this is the sector that's really been lagging that I could see play catch up. But I still say stay in the tech trade. I think the Mag 7 stocks are going to continue to lead us. And, but there are opportunities now in other pockets where I didn't see them just a few weeks ago.
Jay Woods, Chief Market Strategist at Freedom Capital Markets. Thank you so much for joining us.
Thank you.